Hello and welcome to this Sunday, June 16th, 2024 edition of the weekly market recap. I'm Tom Bowley, Chief Market Strategist at Earnings Beats, and I'll be your host here for the next 30 minutes, hopefully, or so, as we take a look at the action last week, some of the things we should probably highlight, talk about a little bit that may have an impact as we move forward. We've got a couple of things we're going to have to deal with this week for sure. And I'm going to get into some of those things in just a couple of minutes. But first, I do want to walk you through some of the charts that I'm looking at on the key indices. Also, take a look at some of the individual industry groups that performed well last week and what that might mean as we move forward. And then we'll wrap up a little talk about inflation, some of the things I think the Fed is looking at, and what we might expect from the Fed and from the stock market in the balance of the year. So let me go ahead and pull up first the chart that I have on the Dow Jones and start with that. So this is just a daily 1-year chart, but you can see over the course of this past week, we did see a little bit of action to the downside in the Dow, which was obviously different than what we saw on the S&P 500 and NASDAQ, as you'll see in just a minute. But we did roll over. It seems to me like we are in this sideways consolidation, maybe off of an uptrend. It's not exactly symmetrical, but maybe you could look at this as an ascending triangle. Not exactly equal highs, but pretty close. You've got rising lows. We're sitting in the middle of that right now. Certainly, we could look at it as sideways consolidation where we just have highs up near the 40,000 level and lows down around 37,700 or so. That's kind of the range that I would be looking at right now on the Dow. The Dow is not nearly as overbought as we'll see on the other indices, simply because we've seen a lot more sideways action and not the straight up move that we've seen on the S&P and the NASDAQ. One other thing I want to focus on these charts as I go through is look at the AD line. So even though the Dow has kind of gone sideways and is off of its high here over the past few weeks, check out the AD line, which is now moving to another new high. So the Dow is showing the tendency to close pretty well in the afternoons, which I believe reeks of accumulation. So for those who think this market's setting up for a major decline, I just don't see it. And as you look at these AD lines as we go forward, I think you'll see that as well. S&P 500, this chart's a little bit different than the Dow. Instead of having pullback here over the last 2 or 3 weeks, we actually see new all-time highs. The S&P 500 moved up, closed above 5,400 for the first time in its history. That occurred on Wednesday of last week. We held it into the Friday close, still trading up above there. But I will tell you, we've got an issue with options week coming up. I always refer to this upcoming week as opposite George week, and it's a Seinfeld reference. I don't know if you're a Seinfeld fan, but I am, and it's a pretty funny episode when George is always whining and always complaining about, things not going right in his life. There's a blonde who walks into their diner, and, George is like, well, she's not going to be interested in me, kind of taking that negative approach, and then goes on to talk about how everything in his life is bad and blah, blah, blah. And Jerry says, well, if all the decisions you make are wrong and, you're always, depressed and all, said, why don't you just think the opposite and start doing things opposite than you would? And so, of course, he walks up to the blonde and talks to her, and the rest was history. Is a pretty funny episode. Anyhow, when I look at the market, it reminds me of opposite George week, because everything that's working heading into option expiration week, a lot of times just all of a sudden fades away, and things that aren't working suddenly come to life. So that's the way I approach it going in. And there's a lot of historical fact that supports this notion. The worst week of any calendar month, when you look at the calendar months historically since 1950, going back 75 years, the period that runs from the 19th to the 25th, and of course that the dates will vary each month, but over time, the 19th to the 25th has been the worst week of the calendar month. And particularly the 19th and the 20th, those 2 calendar days tend to be very, very weak. So a lot of it, because the stock market goes up more than it goes down, when you go into option expiration week, you have a lot of in the money call premium that's sitting on the table that market makers, if they just happen to use some capital for a short period of time on the short side, they can bring that premium down and pay out a lot less than options. I'll be talking about this on Tuesday. We do a regular Max Pain event, always the Tuesday before the monthly options expire. So that will be this Tuesday, the 18th. So if you'd like to check that out, please do. You can go over to earningsbeats.com, sign up for a 30-day trial, and you get set up for that event. But I think this is going to be one of those weeks where we might see some selling out of the blue. And I think if we do see the selling, it's going to be fairly short-term in nature. It could be swift. It could be sudden. It might be significant. I wouldn't be surprised to see 3 to 5%. I think it's possible, maybe over the next week to 10 days. So something just to keep in mind. From what I looked at, I believe this is the most in the money call premium I've ever seen when I'm looking at the Spider, SPY, the QQQ, and a lot of the FANG stocks or the Magnificent Seven, whatever you want to call them. There is a tremendous amount of net in the money call premium, which means market makers have to pay out that premium. Now, don't worry about them. They're not going to lose money. When someone buys, if a retail trader buys an option for a stock, one thing the market makers can do to protect themselves is sell that call to them and then buy the underlying stock. It's called a covered call strategy. So they're not really on the hook, but it's just that they can make a lot more money if suddenly the market were to come down and all of those options get taken out. So just something, again, we'll talk about this more on Tuesday, but anytime I see the market sitting at an all-time high like this going up, and by the way, the last 3 days, most of the gains have been on the opening bell. I mean, we're closing not too much above our opens. Wednesday, we did close a little bit above the open, but Thursday and Friday, not so much. We actually closed a little bit below. So we may already be seeing a little bit of that, movement back, to roll back over. We'll see how the week unfolds. But just remember, you've got some issues with options expiration this week. NASDAQ 100, probably even bigger options worries ahead. But here you can see on a price basis, I mean, we're breaking out. PPO looks great. Remember we had that negative divergence we talked about when we first made the breakout, clear negative divergence. Anyone who acted upon that had the carpet pulled out from under them. That's why you've got to be very careful when these negative divergences first appear, because you don't know how far the rally is going to extend. Here, the rallies kept going, and look, there is no negative divergence anymore. Now it looks like we've got very, very bullish momentum. When I talk about a brief pullback, I could see a 20-day test. And so on the NASDAQ, we're talking about maybe, 700 points, something like that, which would be maybe close to 4%. So again, in that 3 to 5% range. And that's just, there's no guarantee. Market can keep going higher. I am very bullish the long term. I cannot stress that enough. I'm very bullish. I believe we're in a secular bull market. I've been talking about this for the last 12 years. I don't see any short-term warning signs other than the fact that we do have a lot of these in the money call premiums to at least keep in mind. All right, IWM doesn't have that issue. First of all, small caps for the most part are not traded heavily with options. So we don't really have to worry about a lot of small cap stocks in that way. The actual IWM itself has just been trending sideways. I mean, it continues to underperform pretty badly. The QQQ last week, look at the last 3 days. So we had that beautiful move up on Wednesday. What happened Wednesday? We had the May CPI data come out, and it came in much, much lower than expected. And as a result, we saw many areas of the market gap up. But the large cap growth held on to those gains and even built on those gains to the upside. Small caps were down all week after that Wednesday open. So the intraday activity, action, I'm not sure what we want to call it, but just does not favor the small caps right now. And it did for a while, but it does not right now. I'm not ready to give up on the small caps yet, but I can tell you I'm not going to really feel comfortable about this group until we get the breakout above 211. Because every time we make a move to the upside, we seem to end it with a very uninspiring move back to the downside, not just on an absolute basis, but also on a relative basis to those larger cap growth names. Transports continue to be, moving in this downtrend. I did find that reversal on Friday to be very bullish because we've had some key lows at 14.8. Let me zero in here and so you can see this. But just the end of May, 14.8, just a little bit below. Here, just a little bit below 14.8. We come all the way over here, just a little bit below 14.8. So the fact that we came down here, went down to 14.5 and change, and came back up and closed just below, or actually right at 14.8. I think that's pretty encouraging in the near term. So when we talk about opposite George week, the things that have been working, we got to be careful with. Large cap growth, the NVIDIAs, Apple's made a big move. Be careful. Again, I'm not saying they can't go higher. I'm saying that the risk is higher in either holding them or in buying them. If I was looking to buy Apple or buy NVIDIA as we head into option expiration week, I would tend to try to be a little bit patient and see if I can get in a little bit cheaper. So that's how I would approach that. But other areas of the market, like the transports, which have not performed well, I think are set up to maybe have the baton passed to them. And you might see some strength in areas where we haven't been seeing strength while money rotates away, just short term, rotates away maybe from some of that high octane growth area. So maybe we'll get some relief in the small caps. Maybe we'll get some relief in the transports. Maybe, some of the materials. I mean, steel has been horrible. Aluminum has been down for a while, closer to a key support level. I mean, areas like that might see a little bit of outperformance. Industrials and financials have been underperforming more recently. Might see a little bit more action to the upside in those areas. That's some of what I would be at least thinking about. Last week on the volatility index, we did finish down near the 11.5, 12 low that we've seen over the last year. I mean, that's been the area where that we've kind of gravitated toward whenever the market's been strong. As prices go up in the S&P 500, the NASDAQ, we tend to see prices or the volatility index drop. They tend to move opposite one another. And we're down in a range right now on the VIX where the S&P 500 tends to do extremely well. I mean, when we dropped, of course, we were very, very pessimistic and a little fearful when the VIX back at the end of October was up around the 20 level, maybe even just a little above. But that move to the downside is what sparked a major rally in equities. Look at what happened in April. We were up near the 20 level again, pulled all the way back, and that sparked another rally. We went back up to new all-time highs on both the S&P 500 and on the NASDAQ 100. So studies I've done tell me that when the volatility index is this low, you want to be long the market. Now, that is a contradiction to next week. That's a short-term move. I think that we always need to recognize what can happen in the near term around option expiration week. And the reason is simple. History tells us this is when the market tends to struggle much more. And the fact that we're at an all-time high going into this week, I think we at least have to be on notice. Now, it doesn't mean you're going to start off Monday morning, you're going to sell off all the way through Friday, you're going to have this big, huge down week. Could happen. We may not see selling start until Wednesday or Thursday. Maybe into Friday. Maybe it'll carry over into the following week, which we see sometimes. There's no timetable that can be set on this. I'm just telling you that the risks are higher. And as a trader, as a long-term investor, I would be ignoring everything I'm saying right now because this is a short-term phenomenon in the market. It's not something that I'm worried about, escalating into some major sell-off, at least not based on what I'm seeing now in my signals. But I do think we could have a short-term issue, which is more applicable to short-term traders. As a short-term trader, you want to evaluate the risk. And at least if you say, hey, I'm going to stay long the market or I'm going to keep buying stocks, that's fine. Just understand the risk you're taking. In my opinion, risks are higher. All right, let's move on to some of the areas that really did well last week. Semiconductors. I mean, this group just isn't stopping. And I want you to think about something. These companies that make up the semiconductor index are very, very strong growers in terms of both revenues and earnings. Strong earnings growth is what drives valuations. Okay. When you've got companies like this that are continuing to move higher and higher, their valuations are going up normally based on two things. One is either stronger earnings expected down the road, or two, better interest rate environment. And I think it's both of those things. I mean, if you've seen the earnings that have come out in some of these companies, they're just blowing numbers away. Anybody who is fearful about this market is not paying attention to earnings, because the earnings that are coming out have been absolutely spectacular, especially in the semiconductor area. But I think the interesting part here is, and I'll show you another chart a little bit later, but the market always tells us a story. I get my stories from charts. I don't get my stories from CNBC or media outlets. I get my stories from the charts. This is where the money's going. This is Wall Street basically telling you where they're putting their money and what they expect down the road. And so when you see areas like semiconductors doing so well, these high growth, if we're headed for a recession, and I've talked about cracks in the economic foundation, I don't believe we're going to have a recession. I think right now the Fed is teetering. I mean, I think the Fed could create one. I think right now the stock market is saying we don't think the Fed's that dumb. Honestly, what I'm thinking. And even the bond market starting, we've had pretty strong action in the bond market, sending yields lower. You don't get that kind of action if you're worried about inflation. You don't get money rotating with massive volume coming in into high growth areas if you believe inflation's a problem, or if you believe we're going to have a recession. This isn't what happens. Money rotates out of these groups. These stocks that are flying right now were absolutely getting killed back in late December and into January of 2022, before that cyclical bear market. They're not showing any of those signs. Why are we going to try and bet against where Wall Street's putting their money? I say stick with the market. Short term, yes. Again, short term, got some issues coming up. Beyond that, we got another earnings season coming. I see another big move to the upside. Anyhow, next area, computer hardware. Of course, Apple is the main reason here, laying out some of their plans for AI. And of course, anything AI immediately gets a spark. But this is a massive breakout to an all-time high on the computer hardware index and on Apple. I'll pull up Apple for you. I mean, here's that breakout. We went from beginning of the week, we were, low 190s. And by Wednesday, the day we had the Fed meeting and the Fed announcement, we had Apple up to 220. Now that's all great and it's good for the long term, but now you've got a lot of folks that have poured into Apple options just before options expire, with them coming up this week. I haven't looked at Max Payne on Apple. Yeah, I can't pull it up right now, but we're going to be talking about that on Tuesday at the Max Payne event. But yeah, Apple right now looks great for the long term, but in the short term, you do need to be careful. Another area performing well, home improvement retailers. Kind of interesting. That usually is a good thing when rates are coming down. A lot of folks could refinance, take money out. They could do things to improve their home. So I think it's always nice to see the home improvement retailers starting to jump. There's a level that they need to clear, which is up at about the 790 area. If we get that, I think we could go all the way back up, maybe print the right side of a cup back near that 875 level. Software really hasn't been performing that well. We can go down here to the bottom. This is actually the relative strength of software relative to the S&P 500. And you can see not very good action there. Continues to drift lower, but AD line keeps going higher. So what I think is happening is we're seeing gap downs and it's followed by some buying. That's how the AD line moves up, by finishing strong in the afternoon. So I think this is sideways consolidation, which is extremely bullish. And if we get a breakout on the software index, we could see a run in some of these software stocks that might be comparable to the runs that we've seen in some of these semiconductor stocks. Now, probably some of these software stocks are also subject to max pain coming up this week, but you can see by going sideways for the last 3 or 4 months, it's not going to be as significant as many of the semiconductor names. Moving on to hotels. Hotels also looks like maybe some sort of a cup here over an extended period of time off of an uptrend. Look at the AD line really soaring here over the past 2 or 3 weeks, moving straight back up to the upside. I love that. PPO moving back above center line. We're now trending above the moving averages, which is good. The question is, can we get back through what appears to be a little bit of a neckline, maybe around that 3650 to 3660 area? That's where we were. Let me give you some numbers, exact numbers here. Actually, that intraday high was 3702, but the close, that was 3631. There's an open 3641. The close on Thursday was 3637. So 3640 to 3650. If we get a close above that level, I think that's going to take us back up to 3800. And, you know, both the hotels and the home improvement area, those are both discretionary levels or discretionary areas of the market. So when you look at the consumer discretionary sector and we pull it up on a seasonality chart, I've been talking about this. We had a seasonality report we sent out to members at the beginning of June, and we talked about the fact that consumer discretionary outperforms all the other 10 sectors in only 1 month. It's June. So this is the month when we typically see the consumer discretionary group really start to pick up steam. This is just over the last 5 years, by the way. But we've got June averaging 1.9% over the last 5 years, July 7.3%. And we go up every July over the last 5 years. And 4 of the last 5 years, we've gone up in June. But if we stretch this back to the last 12 years, actually, if you look at that last 10 years, July has been up every year for the last 10 years. But let's go back 12 years. That's from 2013. That's when the S&P 500 broke out above the 2000 and 2007 high. That, in my opinion, was the start of the secular bull market. You don't know you're in one until you get that breakout. So anyway, since that time, you can see July, we've gone up, XLY has gone up over 90% in the month of July, 75% in the month of June. Now, if we look at it on a relative basis to the S&P 500, and we go back 12 years right here, you'll see that June, the XLY outperforms the S&P 500 67% of Junes. So it's basically 2 out of every 3 years. And the average outperformance above the S&P 500 is 0.9%. So this is a pretty good area of the market, during June. And because the XLY has not really performed anything like the XLK or even the XLC, I don't think we're going to have the same max pain issues in a lot of the areas of consumer discretionary. So as money rotates away from maybe some of the technology, if it occurs this week, we could see some of that money rotating into the XLY as well as materials and energy and maybe some of the more defensive value-oriented areas of the market. So anyway, just wanted to point that out. All right, now this is one of the big things that occurred this past week. We had the CPI report out for May. We had the PPI report out for May. And we also had the Fed, 2-day Fed meeting, Tuesday and Wednesday, with the announcement, the Fed policy statement out at 2 p.m. on Wednesday. So all in all, I think it went pretty well. We had the CPI report out on Wednesday morning. It came in a little bit below expectations. Then we had the PPI report out on Thursday morning, and I mean, it was way below expectations. So we're getting a lot of really positive news on the inflation front. In the middle of that, though, Wednesday afternoon, the Fed had to give its latest interest rate decision. They decided to keep everything the same. I think they probably should have cut personally, but they didn't. And what they effectively said is that we're pricing in 1 rate cut for the balance of the year. There were some interesting questions that came up, though. I think, what's his name? Steve Leisman from CNBC. Been following him for years. I like to listen to him. Anyway, he asked the Fed point blank, why, with the great reading on CPI that came out Wednesday morning, why are they waiting to cut? And the Fed came back with something that I've talked about, which is that the next few meetings, you've got some difficult comparisons because those same readings last year were low. So we could get a surprise reading on the CPI, or maybe a couple that are above last year's readings, which means the annual rate would actually start to tick back up again. And so the Fed's making the argument we need to see that that's not going to happen. So I think they've left the door open for more than one rate cut. But I think starting next month, the June report, June CPI, July CPI, August CPI, that all come out the middle of the next month, or maybe around the 10th, 11th, something like that of the next month. So we're going to be getting those reports in July, August, and September. And that's during a period when the market typically doesn't do very well during a presidential election cycle year. So, it's all the timing is going to be very interesting. And that's why I've said, I think the market could have a hiccup later this summer for the exact reason that the Fed pointed out. But I think the point that was raised by Steve Leisman was very accurate and needed to be pointed out. And that is, we saw a really low CPI reading for May that just came out, 0.16. Let me show you on this chart down here, and I'm going to zero in. Actually, this is just a long-term chart of the monthly CPI, which is just gets tacked on every month. It always goes higher. It's just usually a very small amount, normally between about 0 to 0.3 is where most of the readings fall. This was the S&P 500, but down below I have a couple of rates of change on the inflation rate, 1 month rate of change and a 12-month rate of change. I'm going to shorten this chart down to 20 years just so we can see that a little better. And then I'm also going to increase the height on these rate of changes. Let's take a look at this. So here's the monthly readings. Here's the S&P 500. And this is where inflation peaked back in 2021. It has now been over 3 years that we have seen this monthly rate of change decline. We've had some gyrations in here, some volatility, but I think you can kind of see that it has been moving lower and lower and lower. And as a result, we got a double top in the annual rate of inflation. But look at what has been happening now for over a year and a half. We have been going straight down. And what the Fed keeps saying is we need to see sustainable move toward 2%. Now, I look at this, and for the last year and a half, I see 6.7%. Now we're at 3.4%, and our target is 2%. Is that not sustainable move to the downside? What qualifies as a sustainable? That would have been one of the questions I would have asked if I was talking to the Fed. I would have said, okay, we were at 6.7%. We're at 3.4% now. You're trying to get to 2%, and you're still looking for a sustainable move to the downside. Do we need to get to 2%? Is that what you need? Is there a level? Because we've already dropped from 6.7 to 3.4. What are you doing? What are you waiting for? You waiting for the economy to turn sour? Anyway, this last reading really was a little bit of a game changer to me. Here's that 1 month rate of change. I'm going to zero in on it. Take a look. During these moves to the downside, this was the lowest reading on the monthly CPI that we have seen since we topped back in the first quarter of 2021. The lowest reading. Just took out all prior lows. Again, I don't know what the Fed's waiting for. I think they're making another mistake, but that has been their track record, to be very slow to do whatever it is that they need to do. And so I understand inflation is a big problem that we always need to be aware of. I just think that we are way, way, way on the well on the way to getting our inflation back down to that 2% level. And the bond market's telling you to forget about inflation. The stock market, the way it's trading, is telling us to forget about inflation. And yet the Fed doesn't want to forget about inflation. They're the only ones at this point seem to be worrying about it. S&P 500, I wanted to point this out just looking at this longer term. This was back in the 1970s. And so if we go back and we look, I already got off that 75-year chart, but this was when we started seeing the signs of inflation. When inflation peaked, it was at the beginning of 75. And look at what happened from 75 on. once you peak in inflation, that's when the stock market tends to do its best. Once you start to roll over. And so we did that about a year and a half when we really started to see that inflation peak and begin to roll over. And that is when we saw this big advance in the stock market throughout 2023 and into 2024. So the market's doing what it does when inflation is coming back down. When inflation's a problem, it eats into future earnings. And so your price earnings multiples go down. Valuations go down because of rising inflation. Valuations go up when inflation is coming back down. That's one of the reasons why the stock market keeps going up, is that inflation continues to drop. And it's going to continue to drop. And we're going to go back down to the 2% level, which is why the stock market is going to keep going up. And it's going to only be exacerbated by the fact that rates are going to get cut. Once the Fed is beyond comfortable, I guess, they're going to start cutting rates. And when you start cutting rates, valuations go up because future earnings are worth more in a lower interest rate environment. Anyhow, that was the 1980s. That was the inflation period back then when we peaked in the early 80s. And then, of course, we had that 2-year move to the upside. This is the last thing I want to show you, though. And this is dealing with the growth areas of the market. So as you see the S&P 500 move higher here, for a while, we had the QQQ underperforming the S&P 500. So that's a sign that the S&P, which is a little bit more value-oriented than the QQQ has much more weighting towards the large cap technology names, the heavy growers. And, you know, the S&P and the QQQ both have similar leadership in terms of the stocks that make up the most, you know, the highest percentage of both indices. However, it's much higher. Apple is much higher representation of the QQQ than it is the SPY. And so anytime that the QQQ SPY is going up, it's a sign of risk on. Market participants have an appetite for risk. That is what drives bull markets. So anytime growth is doing well, it's hard to argue against it. I mean, you can try, but I mean, look at the QQQ versus the spider straight up. Drop down here to the IWF, IWD. This is the large cap growth versus large cap value ETFs. Look at this thing. I mean, even when we were weak, we went down a little bit, maybe back in April. We kind of hesitated for a little while. Look at where we are right now. I mean, it's really hard to argue about the S&P 500 wanting to go higher when you've got growth leading like it is right now. Large cap growth, that's what drives the S&P 500. I know I've seen so many folks trying to pull out these equal weighted ETFs and try to use that as a reason why the stock market is not going to go higher. Well, the S&P 500 goes up because of these large cap weighted stocks. It doesn't go up because of all those hundreds and hundreds and hundreds, even thousands of small cap or of smaller cap or value stocks. They go up because of these growth names. And what this chart's telling me is that growth is in favor. So why would you try to argue against it? That's how folks miss out on big moves in the stock market. They always want to try to bet against. Oh, it can't be going up. It's because of this reason. Oh, I heard this on CNBC. And oh, what about this? And oh, what? Pigeonhole, anything that they can find that looks like it might not support a bull market, they hang their hat on. And then they lose the opportunity cost of actually just being in the market and letting it ride. Anyhow, growth, both of these ratios really strong right now. Now, XLY, XLP, this is a little bit more, well, I mean, our GDP is 2/3 consumer spending, roughly. And so watching to see what areas of consumer spending are leading or getting the most attention, that's pretty important to which way the stock market goes over time. Now, you're not going to see this XLY, XLP ratio going up every day, every month, even every quarter or year. You're going to have periods of consolidation. You're going to have pullbacks, just like you do in stocks. You know, if Apple goes from 100 to 200 and then goes sideways and trades down to maybe 170, 175 over the next 6 months, it doesn't mean all of a sudden Apple's a bad stock. It means that the market cap or its business needs to catch up to its market cap. Stock market's projecting what Apple is going to be worth, and that takes the price of the stock higher. And then you have to wait for it to catch up. You go through a period of price consolidation. I think the XLY, XLP, that ratio is the same. You're not always going to have more money going into discretionary. So you're going to have periods where you accelerate, and then you're going to consolidate, maybe even decline for a little bit, and then move back up. This is one signal. It's a big signal for me. I like to follow the XLY, XLP. When this is going up, there's no doubt I am bullish. And we saw from the end of October last year through the latter part of December, when we had, I would say, probably the strongest move in the market over the last year, it occurred when the XLY, XLP was going straight up. So that's much better than the alternative of what we've been seeing, lower and lower. But we haven't lost any major support levels on a long-term chart of the XLY, XLP. And we did this month in June here start to turn back up. And again, consumer discretionary, as I just mentioned to you on a seasonal basis, loves the month of June and especially July as well. 2 really good months. So I'm seeing this starting to turn back around. Again, I would probably put a neutral on this. I wouldn't say it's bullish, but I wouldn't necessarily say it's bearish either at this point. Let's look at the large cap growth versus the large cap value index on the Dow Jones indices. Same thing as the IWF, IWD, very similar type reading. And you can see the chart looks very similar. But how about mid cap growth versus mid cap value, and then small cap growth versus small cap value? They were going down earlier this year, starting in March. And when we had that weakness in April, the growth stocks definitely took a backseat to value. But as we get now, I mean, May through August, I've said before, is the strongest period of the year historically for growth versus value. May through August, which is a big reason why I think it's hogwash when people start talking about go away in May. Why? You're giving up the best 4 months of growth versus value if you go away in May. Makes no sense. Anyhow, as I look at this, I see these starting to turn back up. And if you look from the beginning of May to where we are after the solid start that we've had to June, because in June, we're seeing growth against moving up against value again. So if you're thinking that the stock market is getting ready to go lower, I would argue in so many ways that that is not the message that these charts are sending us. It looks to me like the market wants to go higher. And speaking of that growth versus value, last chart I'll show you is the seasonality chart that I pulled up before May to let everybody know, hey, don't go away in May, because you got to remember this chart right here. Well, this is IWF relative to IWD. So this is the growth ETF, large cap growth ETF versus the large cap value ETF. And it just shows you the seasonality. And I've done it over the last 11 years since the secular bull market started in 2013. And look at how the IWF has outperformed the IWD from May through August. This is average outperformance each month. 1.2% in May, 1.4 in June, 1.7 in July, and 1.7 in August. And you can look at all the other 8 months of the year, and not one single month of the other 8 can beat even one of these 4. These 4 are the 4 best of the year, and they're consecutive. May, June, July, August. Add them across. 1.2, 1.4, that's 2.6. Add 1.7 is 4.3. Add 1.7, that's 6. 6.0. That's the average outperformance of growth versus value during these 4 months. Now, you can add up the others if you'd like, but it comes up to roughly minus or maybe plus 0.3, something like that. I can do it real quick. Minus 1.7, that's minus 1.6, minus 0.6, 0.2. Now it's plus 4. Yes, the other 8 months are plus 0.3. 0.3. In other words, when we get out of these 4 months, growth and value are even over the last, well, since 2013, 11, 12 years. But these 4 months are different. And we're seeing that growth right now accelerating again. Do you really want to get bearish? History says no. The current action says no. The only thing as I said earlier in this presentation, the big problem is options expiration. It is a short-term problem. It's not a long-term problem. Once we get a few days past option expiration Friday, which will be not next Friday, but maybe into the middle part of the following week. And the reason you have to take it into the following week is that some of those options are exercised. And when someone exercises a call, that means they're buying the stock. Well, who's on the other side of the trade? Market maker. So the market maker effectively shorts the stock going into the week after option expiration. They still have financial incentive to take the prices lower. Although as you get further and further out, it's going to be less and less. So anyway, next week to maybe 7 to 10 days, I think we have to be a little bit cautious in the market. But other than that, my signals say go. It's go time. Anyhow, that's all I got for you today. Have a great rest of your weekend and hopefully a great week ahead. Happy trading.